Welcome to another podcast of the Riffle series. The Riffle, a podcast series brought to you by 10 Leaves. Today, we're jumping into something that sounds, well, pretty technical, but it's absolutely vital for market fairness. We're doing a deep dive into restricted securities within the Abu Dhabi global market, the ADGM.
That's right. Specifically, we're looking at the guidance from the FSRA, the Financial Services Regulatory Authority there. And really, we're trying to answer a fundamental question.
Which is?
When you have a company, maybe a fast-growing one, that wants to list publicly but doesn't have that long track record of profits, maybe it's relying more on its assets or future potential, how does the regulator step in? How do they ensure things are fair and the market stays stable?
Okay, so our goal here is to figure out how these rules work to create essentially fair price discovery, especially when new investors don't have all the inside scoop that maybe the early guys did.
Exactly. And it's crucial to know who this mainly affects. We're talking about issuers who are listing under what's called the Assets Eligibility Test. That's MKT 2.3.16 in the rulebook.
Right, so think startups, fintech innovators, companies that aren't generating revenue yet, or even, say, mining or petroleum exploration firms. These are ventures where the value is maybe more speculative or tied up in assets.
Precisely. They don't have the financial history to meet the standard profits eligibility test. So the regulator says, okay, you can list, but we need some extra controls in place.
Because if a company did have years of audited profits, the market has more information to work with already. These restrictions probably wouldn't be needed in the same way.
That's generally the case, yes. Much less information asymmetry there.
Okay, let's dig into the why then. What's the core problem the FSRA is trying to solve here by restricting certain shares?
It really comes down to two things. Information and incentives. Think about the insiders, the founders, the very early investors, maybe key service providers. They often acquire their shares much, much earlier.
And likely at a much lower price, right? Sometimes practically nominal value.
Exactly. Pennies on the dollar compared to the IPO price, potentially.
Yeah.
And crucially, they know far more about the company's actual situation and future prospects than any new investor coming in. They have superior information.
And the worry is, if these insiders holding lots of cheap stock can just dump it all onto the margin right after the company lists.
Yeah, that could cause chaos. The guidance itself uses the phrase, it could send a wrong message to the market. It could pank the price, not based on fundamentals, but just because insiders are cashing out. That completely undermines fair price discovery.
So this regime is a balancing act, letting these asset-based companies list because they drive innovation, but putting guardrails up immediately.
Precisely. It balances suitability for listing with the need for, let's call it, post-listing control for a limited time.
Okay, so what is a restricted security then? Let's define it clearly.
Sure, it's a security like a share that is admitted to the official list in ADGM. So it's officially listed. But, and this is the key part, it's subject to mandatory restrictions on transfer, meaning it cannot be admitted to trading on a recognized investment exchange, or RIE, for a specific length of time. That time is called the restriction period.
So you own the share, but you just can't sell it on the open market for a while. Do you still get voting rights, dividends?
Oh, absolutely. Unless you breach the agreement, you keep all the economic and voting rights. The restriction is purely on the ability to transfer or trade it freely during that lockup period.
Got it. So that covers the why, managing insider risk and information gaps, and the what a listed security you can't trade yet. Now, let's get into the who. Who gets restricted and for how long? I understand there are 11 categories, but let's focus on the main ones, particularly the longest lockup period.
Right. The regulator draws a pretty clear line. The longest period, which is 2 years, is generally reserved for those considered the deepest insiders, the ones with the biggest information advantage and who likely got their shares at the lowest cost basis.
So category 1 would be the prime example. Founders, their related parties, maybe service providers who put in early capital, either cash or a loan that got converted into shares.
Yes, they're the core group facing the 2-year lockup. And also category 9, this catches related parties like directors or senior managers who got securities through things like employee incentive schemes.
So even if it's through an official scheme, if you're a key insider, it's still 2 years.
That's the logic, yes. Their influence and knowledge warrant the longer period. Then there's category 7, which is interesting.
Who's that?
Relevant service providers. Think the lawyers, the underwriters, the sponsors involved in the listing process itself, if they receive securities as part of their payment for those services.
Okay, and their lockup is?
Also 2 years. And here's a critical point. For this category, there's no relief calculation, no formula applied. All the securities they received for those listing-related services are restricted for the full 2 years.
That seems quite strict. Even if their service fees were substantial, meaning the implied price per share wasn't nominal.
It seems the regulator views taking shares for listing services as fundamentally different. Perhaps the concern is the potential conflict of interest or the signaling effect. Regardless, the rule is clear. 2 years, full stop, for Category 7 shares. No calculation needed.
Okay, that's a tough lockup. What about the shorter period, the 1-year restriction? Who qualifies for that?
Generally, the 1-year period applies to those who invested early or provided assets, but are seen as having less direct day-to-day influence or maybe less informational advantage compared to the core insiders.
Like Category 2, the non-related investors.
Exactly. These are folks who provided capital, maybe angel investors or early venture funds, but they weren't founders or running the company. They took risk, yes, but passively. So usually 1 year for them.
Makes sense. And what about vendors selling assets to the company, especially those unproven assets that are common in these asset test listings?
Right, categories 3 and 4 deal with this. An unproven asset is something where the value isn't easy to pin down, maybe exploration rights, intellectual property for a pre-revenue company, that kind of thing.
So if the vendor selling this asset is related to the company, like a director selling their personal patent into the firm, Category 3.
Then they're treated like an insider 2 years. But if the vendor is completely unrelated, just a third party selling the asset, Category 4, the lockup is generally shorter, 1 year.
Again, it ties back to that perceived level of insider status and influence.
Precisely. And just quickly, Categories 5 and 6 also carry a 1-year lockup. They cover situations where a company acquires unproven assets after it's already listed, paying with new shares.
Okay, that covers the main durations. What if someone fits into multiple categories? Say a founder, Category 1, who also got shares later under an employee scheme, Category 9. Which rule applies?
Good question. The guidance suggests a kind of priority rule. You generally look to the later category on the list. So in your example, Category 9 would likely take precedence over Category 1 for those specific shares acquired under the scheme. It helps simplify things when people wear multiple hats.
All right, so we know who gets restricted and for how long. But how do they figure out the exact number of shares? Is it always 100% of an early investor's holding?
No, not necessarily. And this is where the restriction formula comes in. It's quite important. But note, it only applies before listing and only to Categories 1, 2, and 9, basically the early capital providers and insiders in employee schemes.
Okay, so what does this formula do? You called it a relief valve earlier?
That's a good way to think about it. It mathematically calculates the portion of an investor's shares that are not restricted. It effectively gives credit for the price paid for those early shares. The higher the price you paid relative to the eventual IPO price, the fewer shares get locked up.
So it rewards investors who came in later or at higher valuations, acknowledging they took less of a free ride.
Exactly. The formula is A divided by B times C, where A is the price the investor actually paid per share, B is the IPO or admission price per share, and C is the total number of shares they hold that are potentially subject to restriction.
And the result of that calculation is the number of shares that are free to trade immediately.
Correct. That's the non-restricted portion. Whatever is left over from their total holding, E's minus the calculated free shares, becomes the restricted securities. And if the calculation gives you a fraction, you always round down to the nearest whole share for the non-restricted part.
That seems fairer than a blanket lockup. And you mentioned a specific threshold for Category 2, the passive investors.
Yes, a really significant one. If a non-related investor, Category 2, paid a price per share that was at least 80% of the final offer or admission price, then none of their shares are considered restricted securities.
Wow. Okay, so if they paid, say, 85 cents on the dollar compared to the IPO price, they completely avoid the lockup.
That's right. The regulator essentially says, at that price point, your purchase was close enough to the public market price that the information asymmetry concerns are significantly reduced. You bypass the restriction entirely.
Okay, once the number of restricted shares is determined using the formula, or deemed 100% restricted for other categories, how is the lockup actually enforced? What stops people from just selling?
2 main mechanisms. First, there are legally binding restriction agreements, or RAs. Everyone holding restricted shares, plus their controllers, has to sign one with the issuer. It's a formal contract forbidding them from selling, transferring, or creating any kind of charge or interest over those specific shares during the restriction period.
A legal handcuff, essentially. And the second,
That's a more practical system-level control, holding locks. This means a technical lock is placed on those specific shares in the company's share register. It physically prevents any transfer attempt.
so the company or its share registry provider, like a bank, has to have systems to manage this.
Absolutely. The listed entity is responsible for ensuring these locks are in place and maintained either through its own systems or by getting a formal undertaking from a third-party administrator who manages their register.
Right. Now, one more detail, Category 11. What if the shares themselves change form during the lockup? Say there's a share split, or they convert from warrants, or the company reorganizes. Does the restriction just vanish?
No, the restriction is sticky. Category 11 makes it clear that if the underlying restricted securities are affected by something like a share split, a bonus issue, conversion, or even a big reorganization like putting a new holding company on top,
The new securities that
they
result.
automatically inherit the restriction. They remain restricted securities, but only for the remaining balance of the original restriction period.
Yeah.
You don't restart the clock.
Got it. It prevents easy workarounds just by changing the paper.
Exactly. Form over substance doesn't work here.
Okay, let's shift focus slightly to the company, the issuer itself. What are the big implications for them? One major one seems to be the free float calculation.
Oh, definitely. This is a huge hurdle. Restricted securities are specifically excluded when calculating the percentage of shares in public hands, which is the free float.
And companies need to meet a minimum free float percentage to list and stay listed, right?
Correct. So if too large a chunk of your shares is locked up under these rules, you might actually fail the listing requirements. It directly impacts eligibility. This means applicants have to estimate this very carefully up front.
How do they estimate, given the IPO price isn't finalized early on?
They have to calculate the potential restricted amount using the maximum anticipated offer price. This conservative approach ensures they don't accidentally overestimate their free float and run into problems later.
And transparency is key, I assume. Disclosure.
Absolutely paramount. The prospectus, the main document for the IPO, must clearly disclose that restricted securities exist, who holds them, generally by category, maybe specific large holders, and how long the restrictions last.
And that disclosure continues even after listing.
Yes. The company has an ongoing obligation. Critically, when a restriction period for a block of shares is nearing its end, the company must announce it to the market 10 business days before the expiry date.
So the market gets advance warning that potentially significant selling pressure might be coming as those shares become free to trade.
That's the idea. Market transparency.
Okay, so who gets to avoid all this complexity? Are there issuers who don't need to worry about the restricted securities regime?
Yes, there are exemptions. Broadly, 3 types of issuers don't need to apply these rules. First, the straightforward ones. Companies listing under the standard Profits Eligibility Test. Their track record speaks for itself.
Makes sense. The second.
Companies that, even if they don't perfectly meet the profit test criteria, are deemed by the listing authority to have an otherwise acceptable track record of profitability or revenue. Maybe they had one slightly off year, but are generally stable.
So some discretion there from the regulator. And the third group ties back directly to the asset test issue, doesn't it?
It does. The regime also generally doesn't apply if the issuer has a substantial proportion of tangible assets in think real estate. Machinery, which the listing authority agrees have a readily ascertainable, reliable value.
Because if the assets are solid and easy to value, the company is seen as less speculative.
Exactly. The idea is that price discovery will be easier and faster for such companies, reducing the need for these mandatory lockups. The risk profile is different.
Okay, this has been a really helpful breakdown. Pulling it together, the whole system seems designed to manage the specific risks, volatility, information gaps that come with listing these high-growth, often asset-heavy or pre-revenue companies.
That's the core purpose, yes. It provides a temporary shield, a buffer, during that critical period right after listing when the market is trying to figure out the company's true value. And the length of that buffer, 1 year versus 2 years, is clearly tied to how much influence and inside knowledge the regulator perceives different groups to have.
Right. The deepest insiders get the longest lockup, while passive investors or unrelated vendors get a slightly quicker path to liquidity. It seems quite logical in its structure.
It tries to be proportional to the perceived risk. Yeah.
So here's a final thought for you, our listener, to consider. We've seen how the restriction formula rewards early investors who paid more by calculating how many shares are not restricted. but think about the fundamental goal. Fair price discovery for companies built on, say, unproven assets like a big mining find or a biotech patent. Is a 2-year lockup, even for founders, always long enough for the market to truly understand the long-term potential or risks of that asset? What happens the day that 2-year period ends and potentially millions of shares held by the most knowledgeable insiders suddenly hit the market? Does that create its own kind of instability down the line? Something to think about.